Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, July 9th, 2025. It's 10:48 a.m. Eastern Time. I'm starting the video, so we're a little over an hour into the trading day. Just a reminder, I'll be leaving town for the weekend, but I'm actually leaving tomorrow, Thursday afternoon. So I'll be working up until early afternoon and be able to get back reply to any comments or chart requests. If I see any new trade ideas, I'll get them out to you. Otherwise, I'll be away from my desk through until Monday. Wanted to do just kind of talk on the markets and even though I'm going to be here through tomorrow or half day tomorrow, I want to go over the charts I'm watching right now and give you my take on where to go and most importantly what to watch. I'm seeing a lot of things coming together right now. So what we have is a market that just won't go down. The momentum has slowed, so it's not, it hasn't completely flattened out, but for the most part, it's not hardly going up anymore. And that's just a recent thing, and that could be healthy consolidation. Again, I'm going to go over, and I would encourage you to replicate these levels to watch because there's, again, a lot of things coming together. I'm going to talk roughly in this order. We're starting out here with just a QQQ, my low volume indicator that's starting to fire. I'm going to go over the U.S. dollar, crude oil, Treasury bonds, then the indexes. So we'll keep back on QQQ, SPY, and VTI, and then a couple sentiment indicators. All right, so again, there's a lot of stuff setting up here, and I think we're on the verge of what could be a big move. And I also want to say this, that I follow a lot of sources in my news feed. I also follow social media more and more in recent years. I'm learning there's a lot of stuff you're not going to get from the mainstream media. It's going to be filtered out. For example, the Carnival Cruise Line short yesterday, I listed a fundamental reason, and you can do your own digging, and you're not going to find that on CNN. They're not going to show you what's going on in those cruise ships because for the reasons you probably imagine. But and so when I go into forums and spend some time there are a lot of people that are just not, been lifelong cruisers, and they're not going on Carnival anymore. And I've learned it's more of the shorter cruises than the longer ones. I get all that. So, but I think it will have an impact because again, when this stuff gets out there, it kind of builds. And again, first and foremost, like on that trade, it was based on the technicals. So when possible, I'll list a fundamental reason why the stock may go down quite a bit. All right. So in that, what I'm getting to is that I in fewer points in history can I recall such almost one-sided bullishness. Now, on one hand, they say that the trade, a lot of traders are still bearish and not in this market. And there's even articles written by some of the reputable, business media sources lately that, there's going to be this, a lot of what I'm getting, the consensus is we're going to have the likelihood of a big blow off top in the stock market, something akin to 1999, maybe not as high, but that's what they're talking about. And it's gotten so far as they're saying when the Democrats start buying, because right now they look at the sentiment surveys, and in the inflation surveys and all these polls, and Republicans are very bullish and all in the market because they're all behind Trump, and yet Democrats, because they don't believe in Trump and his big bloated bill and all his policies, they're the ones on the sideline. And again, this is from Bloomberg or the Journal. It's not my thing made up, and so they're saying, God forbid, when they start getting on board, they see they're missing the boat. We're going to get this huge surge of cash coming in, whatever. And listen, that very well may happen. And I'm not saying this is double speak. I can't rule out the possibility of a blow off top, but I can tell you right now, my convictions are as strong as they have been. The charts are really setting up for what I believe to be a pretty sharp move down in the other direction. And for that reason, because again, I'm polling out both social media and the mainstream media, and the vast consensus, even today I read, was it Bank of America and one of the other big firms up their targets for the S&P 500 year end. I'm seeing bullishness despite what the sentiment surveys are saying. It's pretty rampant right now. And so from a contrary perspective, yeah, maybe it's there. Maybe there's a lot of money on the sidelines and everybody's bearish, but speaking the bullish rhetoric, I don't know. All I'm going to tell you again is I go by the charts. I've been doing this a long time. And if I sit here and try to guess where the market's going based on what it's been doing, that's called recency bias, or what, Kramer or anybody on, mainstream media tells me, then that's the day I need to hang it up, because you're just going to be chasing your tail trading like that. All right. So, with that being said, this is QQQ, my low volume indicator. I've shared this with you many, many times over the years. And so I have a couple levels. And over the years, my levels change. In other words, what I do, it's a simple indicator I came up with decades ago. I put a 10-day moving exponential moving average overlaid on the volume. And I do that because it helps filter out those days. Like last week, for example, is 4th of July week with a one full trading day. Markets close one day and then another half day. You get the times Thanksgiving week, things like that, or just certain, Memorial Day weekend, Labor Day weekend, the volumes taper off. So it helps to smooth out. In other words, what I'm trying to say is don't ever extrapolate too much from one day, a big surge or big drop in volume. So what you want to see is the trends, and you can see here basically I have this purple and the red line. The red's pretty much the extreme where that volume indicator will fall to. And then you get down there like you did back in 2021. So the technical posture, if you guys recall, I was unwaveringly, bullish and bearish on and calling for the big top. We had almost identical technical posture, negative divergences. Then we had some short-term sell signals on the 60-minute chart with that little trend line break. We got in there, and then it just continued to firm up the case to be short. And I also, at that time, covered. We went down, so we had this extended period, that rise on low volume. You have the shot across the bow, which is pretty common. And volume will almost always increase on a correction. Bigger correction, the bigger the volume. You get a lot of surge. And then what happens, that's the initial shot across the bow. You had one last thrust up where you came down, and you pretty much had a double top back then. You can see that right here. You kissed boom, boom. And you kiss this level, the purple line. So volume gets extremely low, spikes up on the first correction. Everybody gets a little nervous, or the first correction there, then another little correction. And so you kiss this line here, and then that's usually it. And again, this is where the damage is done. Just like extreme sentiment, just like extended negative divergences or positive divergences at a low, same thing in reverse. And then the top is usually in at that point. So you're seeing a similar pattern. And you also got, early on in the rally, you do get one period before the rally really gets, the meat of the rally gets going. You have one period where the buyers kind of dry up. You get that low volume. So I'm seeing a very similar, you can see from my boxes here, we had that low volume there. We got the big correction that came after that low volume drop. Then we had this extended period of low volume down here in my purple box, where you're down in the low end of the range. And then that was the big drop. Of course, we were short at the top there, covering at the lows there. And you had the two tags. You've had multiple tags now, so very similar to this situation here, except a kind of a much bigger drop due to the Trump tariffs, the initial liquidation day back in April. Was it? Yeah, it was April. And then that surge up. I just wanted to point out that's what we've done now. We've returned back, and it's usually that final spike down to that purple line that does the trick. Now, I'm going to get to other levels in a second. Just because I would never trade off any one indicator. It's the reason I do these very long-winded videos. There's a lot of moving parts, and I'm going to give you all those moving parts right now, just in case, God forbid, something happens big on Friday and I'm out, or Thursday afternoon, so you have the levels to watch. And it's easy to replicate these charts. Any of my charts, and if you're going to replicate them, you want to use log scaling. You get a whole different story if you use linear scaling, aka arithmetic scaling. But let's jump into, before I get into the equity markets, let's go to the things I'm watching, which again, collectively, this one I'm watching as much for anything. There is an on and off correlation or inverse correlation with the stock market and the dollar. But in recent years, it's been, the big corrections usually were coincided. They did coincide with a big surge in the dollar. Here, I can show you real quick. But it's, again, more of an on and off one. This I'm watching more for gold and silver and the other dollar sensitive assets. And as I showed you yesterday, Bitcoin has a very strong inverse correlation too with the big moves in the dollar. So if you look at what I just threw up is the QQQ in white here. And so you can see in recent years, when there's been a strong UUP are the candlesticks, the orange and green candles, or red and green candlesticks. When there's a big run up in the dollar, like there was back here, you see the big drops in the stock market. Let's just look at the big, the drops in the stock market, all the ones that are very obvious. That one there, wasn't right away, but the dollar was rallying. Then the market paid its price. Dollar was rallying again here. Market paid its price. Dollar was rallying again here pretty strong. Then the market paid its price. And we'll see. Again, this is more on and off, so I don't want to spend too much time here. I just wanted to, again, reiterate, I am bullish the dollar. I think we could be looking at a major low here. Again, it's based on technicals. Let me get rid of that. And that's going to impact gold, silver, which I'm not going to cover in this video. I can in another video, but nothing's changed. If you're new to the site, just go back and you can click on, here, I'll show you how to do it. A couple ways. You can just go to market analysis, all asset classes, and hover on gold and commodities right there. There's also under the resources page at the very bottom. If you click on that, you can always find anything you want by just typing in the symbol tag here. If you just type, I'm going to hit my GDX real quick on the keyboard. It'll bring that up, and then you can go find whatever you want on GDX, any coverage in order with most recent posts. And again, you can also go back all asset classes, gold, commodities, and then you're going to get anything there that had coverage of gold and commodities or anything related, such as the miners. And again, I'm not getting into gold because I'll get bogged down here. Video will go over an hour. I don't want that. But I've showed you many times in the past, there's an unmistakable correlation. Brief periods of disconnect due to overwhelming demand or supply for gold. Other than that, it's just due to the fact that then when the dollar drops, it takes more dollars to buy an ounce of gold. So gold's going to go up. When the dollar rises, gold will go down. And there's the bullish falling wedge, measure target. Again, I covered this recently. So keep an eye on that. That's one of the things to watch. It's a nice setup. Anything's possible. Sometimes you have the best looking setup in the world and it never materializes. You could break down. The divergences could be taken out, negated, meaning we go on to take out the previous lows and we no longer have positive divergence on the indicators. We break down from that big trading range. That'd be bearish for the dollar and a net bullish event for gold. Net bullish doesn't necessarily mean gold has to go up, but most likely due to that impact of, again, a falling dollar, simply takes more dollars to buy 1 ounce of gold. So that's going to cause the price to go up if you freeze supply and demand. So that's what I mean by net bullish or net bearish. Okay, guys, this is a big one. Again, I've covered this recently. My zones, these zones I started laying out early in 2024. So it's been about a year and a half now since I first started identified and labeled these zones. I stretched the orange zone just recently to show you that even before, one thing, the zones were based on technical and the charts, but also there's fundamental analysis behind this. And the fundamental analysis is the rising price of oil, what it does to the economy. We all know that just about everything you're buying, when Amazon knocks on your door to deliver that package, they had a truck that drove it out, that burned gas. There was plastics in the packaging and the manufacturing process, and probably built the product itself. Plastics are a petroleum-based product. Planes had to fly it here from there. Planes, trains, all that stuff. So crude goes down into almost everything, and has obviously one of the biggest impacts on inflation, and can high crude prices can really put the brakes on the stock market. When crude's down in the my zones, it doesn't matter when you're down here. Nobody's talking about it. It doesn't have an impact. Crude could have a 20% up day from down here. That's not going to put the brakes on the stock market. But what happens, it starts getting these zones, it's incremental. And again, I sit here and talk about it, but the proof is in the pudding. I always encourage you to do your own analysis. Right here is the chart I gave you just a couple weeks ago, a week or two ago. And again, it's been zero variation. These are my zones. Again, I started identifying these zones back here, but I showed you even the history without fail. And you can see when crude has entered the orange zone, these arrows show you that, and it's not always an immediate thing. There is sometimes, quite often, a little bit of a lag time, like there was right there. This is the stock market, or QQQ up top. So we entered the orange zone here. QQQ kept going up for about a month or so. Then one of the biggest drops in years. We entered the orange. We actually got into the red zone back then. And same thing. The market went up. Crude was persistently high. Another big drop. Finally, crude prices abated. They fell out of the orange zone, remained out of the orange zone that entire time, and look what happened to the stock market. I'll ask you, do you think that's mere coincidence? You may think it is, maybe not. We were out of the orange zone here, big rally. We were out of the orange zone here, big rally. So the biggest rallies occurred when we were out of the orange zone, the clear trends, the kind you just want to be in, hold on, not worry about, And then without exception, we entered the orange zone there. We had one of the biggest drops in over a year. We didn't enter it again to right here. Again, these are all without exception. I'm not trying to fudge anything on this chart. These, you can see it clearly. The biggest drops, bar none, you don't have to study the chart with a microscope, have all occurred when we hit the orange zone. We just hit it again. Does it guarantee that we drop now? No, there are no guarantees in this game. That's why I sit here and do hour-long videos with multiple charts, but this is certainly one. We just recently hit it. Again, I did acknowledge it was one of the more brief tags, although that one was pretty brief, or I should say we had a pretty aggressive pullback off there. But let me go to the more recent chart. Again, this was just a couple weeks ago. Let's get back to the more recent chart. So that's it. We just hit it here. We were in that orange zone as recently into the top of the orange zone too, as recently as the 23rd. So that's only, a couple weeks ago, just over 2 weeks ago. We had a pretty aggressive pullback. However, we're charging back up. So again, it's a function of how long you get up. You never stay there long. You haven't. You can see that. They come in, the powers that be, whatever it is, natural market forces, the government, they can, if they need to, Trump will release the strategic petroleum reserves and do whatever that, and put pressure on OPEC and the likes and, all the shenanigans they will do. The powers that be, meaning the world's government, especially ours, will do anything they can to keep oil prices from crushing the economy. And that's it. So bottom line is they usually don't stay there long. But again, let me move on. There's the clear pattern. I went back a couple years. It would be different this time if we didn't have not just a pullback, not a 2-3% pullback in the market, which hasn't happened in a while, a double-digit correction like the previous ones I just showed you. So that's it. Hard stop. We had an aggressive pullback, but so far we've snapped right back up. We're back in the middle of the yellow zone. This is a live chart, so that's one to watch. And again, what do I mean by it's one to watch? Well, here's an uptrend line you can see I've added since my last update. If we can do this, and the farther we get away from these zones, the lower oil goes, the more of a net bullish impact that's going to have on the stock market. Why do I say net bullish? Does this have to be bullish? No, because if this happens because the stock market starts crashing and going down hard, it doesn't matter. That's not going to save things if we start breaking support levels. But if this happens with organic forces and market supply and demand, then that should be net bullish. Lower crude prices makes everybody more profitable. The gold miners are more profitable. The airlines are more profitable. You are more profitable because you don't have to now spend as much money commuting to and from work every day, right? So that's that. Either way, and if it goes up, it's incremental. We get back in here. Again, the history shows we've had that hit and we went down and then the stock market correction followed. We haven't had it yet, and I think it's probably going to come. That's why I'm doing this video. I want to make sure before I leave town. My convictions are very high, despite 99% of just, again, what I'm reading in social media. I can't find a bear out there right now, or at least a bearish headline, especially in the mainstream media. And like I said, everyone's lifting price targets and talking about if you Google here, I'll probably do. I haven't done this yet. Okay, here, and like I said, I haven't previously done this. It just as I'm talking here, maybe like to Google Trends, just type in the term blow off top, and you can see here, this is how it trends as far back as I can go. This is your selector button here. You can go back as far as you want. 2004 is usually when we'll go back to, and you can see, you can see when they, where that came from. June 2009. We just started. The market was screaming because the bear market was over. It ended in March, and by June, people talking blow off top. Obviously, people don't know what they're talking about. You can't have a blow off top coming off a bottom. But again, that just shows that, remember, the masses are not as educated as Wall Street experts. But you can see when they come. The last time we had, here we are. We just pinned it. We just hit a pin there. The last time we had this term, people were searching again on Google for blow off top, was, if I can get the little button to snap there. Sometimes it's hard to do. Okay, right around the drop off came right around December 2021. I think you can see that little dot there. I can't get it on the high. So that was right before December 2021, where everybody was, I guess, talking about, because the bobbleheads, the brilliant people on Bloomberg TV and CNBC and everywhere else were talking about a blow off top. So what happened in December 2021? Let's just take a look at the stock market. QQQ. Let me turn off all the lines here. Let's go back here. Here we go. All right, so there's December of 2021. This is now. Again, I'm not making this up. I'm buried in the news. That's all I hear. Blow off top, blow off top, blow off top. And this is what tends to happen. And what it does, it just shows you where sentiment and positioning is right now. For those calling for that, how can you talk about expect it and even the likelihood and not be somewhat positioned for it? So, all right. So that's that. That's just again, a way that I use outside the box sentiment indicators by looking at Google Trends and just kind of trying to get my pulse on what the masses are how they're thinking. Okay, the other indicator that I developed for you back beginning of last year was these zones on IEF. IEF being the ETF for the 10-year Treasury bond. Remember, bond prices and yields move inversely. So this is opposite of the yield. So the lower you go here, the higher yields are going. And my zones, if you followed me for a while, you've heard me cover this a million times. Orange zone says stock market really starts to take notes of rising yields. I tweaked them back in February 29. The red zone, we haven't gotten to the red zone yet. If we get to the red zone, it means yields have broken out to multi or even multi-decade highs on the 10-year. We're not far. We're still within spitting distance of that happening on the 30-year. So I don't think... Let me rephrase myself. It's not that I don't think that risk isn't being appropriately priced in this market. I know that risk isn't being appropriately priced into this market. And that may not happen, guys. Again, let me repeat. We may not break out to multi-year highs in the 30-year or the 10-year. If we do, you won't be able to get into this market on the short side fast enough. You will have missed... again, I think the ingredients are there for a potential crash-like scenario right now. Nobody's talking about it. So... I'm going to throw it out there that I think the ingredients are there. And what do you need? You need these things to come together. So watch this. Here's where we're at. Hopefully you can see these candles. We're just now in the yellow zone. Remember, we just barely kissed the top of the orange zone recently. The last time we were down here was right here, early 2025. We know what happened. We were short for this and other reasons. We had sell signals in the Qs, and we had the biggest drop in years. We made personally a ton of money shorting that down, covering at the lows in early April on the after liquidation day, and reversing the longs there. We also saw it happen here. This is we've had some big corrections. So this is where, again, I'm watching real quickly. I'm sorry, not real quickly. I'm watching this on a daily basis actively. And if we get back down in there again, that would be net bearish for the stock market. And remember, we already kissed it recently. And there is quite often, just like with USO, a lag time. And as I've mentioned many, many times since I first threw this thing out there to you, that the impact on the economy, this is using, again, I'm marrying fundamental analysis and technical analysis together. Technicals of what we're looking at a chart. These are technical levels and developments that happen. The fundamental aspect, just like crude oil, there's a fundamental impact that higher rates have on the economy. Very much so, and virtually an immutable impact, that over time you can't argue it. There are periods, just like higher crude prices, where the market may ignore it for a little while. They may ignore certain warning signs and red flags, but then usually they will manifest in time. This is one of those that you cannot argue the impact that higher rates will have on both the economy, the real economy, and the stock market. And so watch this. And look, guys, I'm telling you, I know I'm kind of pushing it on the bear case as if this is going to or must happen. I think it probably is what's going to happen. I haven't always tell you what I think is going to happen. But if it goes the other way, if you are bullish and you're one of those in the camp that, hey, Randy, I think we're going to have, may not be a blow off top, but I think we've got another 20% upside to come in the stock market, then you want to see this. So if the opposite happens, if we never get back down or into this orange zone and we do this, then that is, again, net bullish for the stock market. That is falling yields if bond prices go up. However, the other asterisks I have in here are any advance, and meaning in Treasury bonds, that means bond prices going up, yields going down, due to a strong stock market sell-off on a flight to safety bid is net bearish, not bullish. All right, so we know that when the stock market craters and goes down hard, at almost all points in time, institutions will sell stocks and move into the safe haven of Treasury bonds. So watch this. There's your level right there. You can, pause the video if you want to replicate these levels if they change over time, but I don't see any reason, because since I've created them, you see reactions around there. It's a very defining and important support level, and that the market continues to react on. And when you get in there, corrections follow. Again, look at this. You know what happened in the beginning of January 20, early in the year. Market long top. Remember, we were short long before liquidation days, long-term swing positions and swing trades. The liquidation day just broke it, and that's when we had a key level that morning, that evening before Trump, or the afternoon before he walked out the podium. I said, this is a lights out level on the futures if that go, and it went that day right after he got to the podium. So it was the fundamental catalyst was him talking. For the technical catalyst was the breakdown, and again, that gave us that final leg down in the big correction we had earlier this year. Okay, okie doke. Let's move on. You got that. Just to kind of look at yields, the 30-year. This is the 30-year Treasury bond. This is a long-term chart. This is a weekly chart. You can see we're still, yields are persistently high. And as I mentioned, we are within what I call spitting distance of all-time new highs. If we break out, again, this is the 30-year right here. You had that previous high. We checked it again recently. If we break out there, let's just say we go up here at about a 5.5% yield. Let's just grab that number, right? So 55 on TYX, the yield of the 30-year bond means 5.5%. I don't know why they do it that way. It's just how they do it. Let's just go with it. So 5.5% yield on the 30-year will take us back to levels not seen since the early 2000s, and right where we were, even higher than we were before the financial crisis. So that's it. So that would take us all the way back here. You can see the years. This is .com bubble right here, 2000, and then the early, all the way into the early 2000s and the financial crisis. And then we had the financial crisis. Yields plummeted because institutions moved into the safety of Treasury bonds. So that's where we're at now. And so the impact, again, to me, cannot be underestimated. And I'll use the word catastrophic. And again, you almost need something like this. I know very few, especially today, I can guarantee you, anybody listening to my voice, those that still are, very few of you, some of you might believe, yeah, Randy, anybody knows a good correction's coming up. This market's overbought, needs a good 3-5% pullback. But your targets, your 50% drop in the indexes is crazy. That all comes together. This is still my final targets, 53% drop from where we are right now in QQQ. And I know very few listen to my voice believe that, and that's fine. I've had these similar type targets on indexes and stocks before, and they were hit and quite often exceeded. Again, so where I'm going to leave you and what I've said before is this is where I think things are going, but you're going to need some catalysts to get there, some fundamental catalysts. And they are, in a case, technical catalysts, the levels that I'm showing you now. So watch crude oil, watch Treasury bonds. It may be neither of those, but those are the two of the most likely suspects to kind of really put the brakes on this economy and stock market. And maybe, there's 101 other things out there on the geopolitical front right now, things going on in the Middle East that could also be a catalyst. So I'm not saying it has to be crude oil, it has to be interest rates, but those are two of the most probable catalysts, if you will. All right, so let's look at, let's dive into the indexes now. We're on QQQ. So, those are long-term targets. Again, I would replicate this. Somebody asked the other day for, levels on QQQ and what it will take. So this is what, at this point in time, the levels that I think are most significant, we'll call the salient levels in the market, is this uptrend line that comes off the April lows right there. And this is our divergence line we've had, as I've been highlighting, divergence building for a while. That was a divergent high, gave us a correction more in time than in price, pushed up, but it simply extended the negative divergence that was already in place. It's grown larger. And so that gives us that's our divergent line, forms this rising wedge pattern. And so break of that, you have a T1 zone, T2. These are just near-term targets. T2, I gave you these the other day. And then T3. And so for those of you that are looking for just correction, you want to buy correction and then get long, go to, or just game that and then maybe reverse and get long for the run to new highs or the blow off top. Those are your potential targets. You can add to longs or cover shorts or turn around and cover the short and reverse the long. Whereas if we get there, keep in mind that if we get down, especially to T2 and T3 here, that's going to be a clear failure of the breakout. These were your previous all-time highs right here. This is the breakout to new highs. Like I've said before many times, it's more than normal for a breakout to see a backtest come in a little bit below the previous highs. And so anything in the T1 zone would be a healthy backtest, right? If we do that and then go on up. Anything much more than that, in other words, T2 and T3, will have done some technical damage. So all those that have chased, all the JCL longs that I call them, Johnny come lately longs, they didn't want to buy here when we were covered shorts and buying, or here. They wanted to buy here or even here. They'll be underwater. So anybody that bought the breakout will be underwater. And the deeper you go, the more stops are going to be hit. And then it becomes a vicious cycle. Then you have the 200-day moving averages. That's why if we get down here into this zone, it's going to, the odds for my longer term targets that I just showed you on the weekly chart being hit will increase exponentially if and as QQQ drops down below this range. So you go down here. So anything below that range, the 200s will clearly be in the rear view mirror. That's going to have changed the whole dynamic in the narrative on TV. Good news will be spun as bad news or ignored. Bad news will be taken on face value as it is. Right now we have that in reverse. Good news is good news. Anything in hopes of a rate cut, the market rallies. Anything that comes in and squashes the hopes of rate cut, such a strong job number, it's spun as good news because, hey, it's okay because the economy's strong. And so you're in that kind of psychological loop, positive feedback loop. And again, that the charts will reverse that kind of that thinking, if you will, all right, on the market and how news is processed. So that's it. And we're a long way below there, right? Above there, I'm sorry. Long way above there. We have to, just to get down to the 200s, we have to drop about 9%. To get under the 200s, to get to the top of that zone, we have to be down about 11%. And then to drop below that zone, about 15%. But that would be your first objective short entry, a solid break, especially a red close below that trend line. And, you know me, I like to watch multiple indices. SPY, you can replicate the same trend line off the bottom. Remember, use log scaling. If you don't, you're going to get different trend lines. There's the beautiful bearish rising wedge on SPY. There's the previous all-time highs right there at just about 613, a little below. So break of the trend line would be the first bearish technical event. Break below 612.90 would be the second. Again, not end of the world, but then it gets incremental. This is a big level right here. This is a level that if you are bullish and you get a correction, you could buy down, I think, to that level, the 595. They'll probably buy it there. It's nice support. It's a target I have in a pullback. Anything more than that, it's going to be that rut row moment for the bulls, like Scooby-Doo rut row. If that happens, that's 595, give or take. Then the 200s, and then it's kind of lights out below there, right? Okay, so there's SPY. And then VTI is really the stock market. It represents the entire stock market. It has large, mid, small caps, micro cap, and you can see an identical rising wedge on it. 303 is that where the previous highs were, right around 303, and we're barely above there now. So it is what was predicted. If we went up and all the way back here in the market and SPY and QQQ. Once we took out the 200s, I gave it about coin toss odds that we'd have a marginal new and still divergent high, and that's exactly what we have. And that's exactly why at this point in time, my longer term outlook hasn't changed. But we have no sell signals, or we don't have any sell signals to be grammatically correct. But if we break the levels that I talked about, then we do. There's another support level that needs to go target on 298 on VTI. And then I'm going to move that one up. These are your first three support levels. I'll read them out. 303, 39, 208, roughly 290, 250 on VTI. And just to excuse me, sorry, I tripped over my tongue there. Just to reiterate, we have absolutely no sell signals at this point in time. We're above trend lines. We're above trend. We're at new highs in the market. So we need to at least put in sell signals can come on breaks of those trend lines I gave you. They're fairly well defined. They're not super well defined. All the better to see some type of solid candlestick reversal patterns. There's many out there, including but not limited to bearish engulfing candles at the high, or island top or island cluster top. Evening star dojis. There's a lot of them out there. This is VXY, the VIX tracking ETF. And this is still, we have, as I mentioned recently, no change in the technical posture, and it's going to drift lower as long as the market goes higher. But you have that positive divergence, just like you did here and here when we had that 100 and both of these triple digit rallies. And that was, again, first, second target hit, pull back there. And if we get the breakdown soon, probably have a little trend line here I can draw now. Let's see. This thing's going to decay a little over time because it's rolling the futures. But either way, we'll leave that trend line there. It's not. You want to see a sell signal in the market to make a strong case to get aggressive in the VIX. But I wouldn't, if you get it, my point is you may need to jump in soon. If it came tomorrow afternoon or Friday while I'm out, I'm not going to be able to post that. This thing can rip, and that is still, again, my rough target now. I always go off the spot VIX and VIX futures, and that still has positive divergence, and I've covered this many times. Where's my weekly? Right here. We're still at the trend line right there, and I'm kind of looking at the next leg down will probably hit or exceed this level here if we get down to my deeper targets on the S&P 5 or QQQ and SPY, and that's going to be about a 460% rally from where we're at right now in the spot VIX. Okay, I'll wrap the video up talking about sentiment. There's a sentiment we can kind of glean from these indicators. This is one of what I call the rhetoric indicator, the bull-bear spread, because it's this weekly survey. The participants, check a box or state whether they're bullish or bearish. And just because you say you're bullish doesn't mean you have to buy any stocks. In fact, you could be the most bullish guy or gal in the entire world, foaming at the mouth bullish, calling for like a 50% blow off top in the market, big rally this year. But guess what? You may have all your money invested and you don't have another penny to buy. So there's kind of that goes on with this. Or you may be that bullish, you have all the dry cap powder in the world, but something happens in the next in the coming weeks or months that changes your mind and you decide not to put your money in the market. So I'll get to the put to call ratio in a second. That's my money where your mouth is indicator. But as far as the rhetoric indicator goes, a lot of people follow this. I look at it, it's worth noting. And if after a big top, I've talked about this. In fact, one of the subscribers mentioned, we're sentiment just got bearish. This is right when the market topped, and we were short and bearish, calling for this big drop. And they said, no, it's not going to happen because now everyone's got bearish. I said, well, that's exactly when it happens, as I pointed out here. The biggest corrections in bear markets typically come well after bullish sentiment has peaked and shortly or immediately after the AAI bull bear ratio is crossed into negative territory. You can pause the video, look at the arrows, and see. But these are the big hills. Those are periods of extreme bullishness, and it's only when that subsides that's when the top is in. So it's almost contrary to what the bobbleheads on TV are telling you. Oh, because everyone just got bearish, now we're not going to go down. It works the opposite. You have this, again. I have different interpretation. I look at charts and I study charts, and I kind of glean from them what I see, not what others say. And sometimes, quite often, it's opposite what others are seeing there. And you can see again. So it's that flip from extended period of bullishness to bearishness that the big drops and corrections come. Now, where am I going? Okay, I already talked about that back when it happened. I put that right. Created this note right back then and addressed it at that time, and then we got that. We got, again, the biggest drop after everybody had already started to get bearish, and then the big drop still came. Now, there's point in doing this. So everybody, guess what? After this extreme bearishness, and they've been talking about a lot, according to this survey, everybody's getting bullish fast. And guess what, guys? If that was a major top, and again, to me, a marginal new high, this is, semantics. Technically, it's, a new high. It can't be part of the bear market, but it is. My book, it is. You always get a kickback rally in a bear market. The first kickback rally, this one's been on steroids, given. But back in the bear market back here, I know the NASDAQ, I made the mistake of not doing log scaling on this chart down below. Let me just roll down here and give you the, so you can see the year breaks. And so it makes it look like these moves were a lot smaller. This was a 55, 56% bear market in both the S&P and NASDAQ. I happen to have the S&P down here. And that bear market rally, especially in the NASDAQ, was very significant as well. But again, it doesn't look like it if you're not using log scaling. It doesn't put everything in equal percentage moves. It just doesn't in point moves, and that's different. So it'll understate the scope of the move. But where I'm going with that is, this was you can study. I know we have to zoom in here, and hopefully you can see it in your video. This was the first leg down in the bear market in the financial crisis. And then 2008, we had the first big bear market rally right there. And you can see my line. So same thing. We're bullish. We flipped to bearish right at the top of the market. We had extreme bearishness on that first leg down. Then everybody got giddy, and it was over, and there was a big fat rally. It was powerful and strong, like this one we're having now. And it took that mid bear market spike, or that first spike back after the bear market started. It took that first spike back into bullish territory, and given it got a lot higher, but again, before the next leg down and the most powerful leg down could begin. And then you got all that. And then the bear market ended here with extreme bearishness, right? All right, so you can see that here. Okay, let's study the last bear market. Last bear market we had was in 2022. There was a peak. Same thing. You had this extreme period of bullishness. Everyone got bearish right there, right at the top. So while on TV they're saying, "Oh no, we're going to go higher because everyone's sentiment surveys just slipped to bearish. Everybody's bearish." Didn't matter. That was the time to, that was the top. Then we had this first bear market rally right here. And what happened? You can see it coincided with the first flip back to bullishness. And then another leg down. So again, they don't always play out the same. I'm just showing you traits. This is why, I bury myself and study these charts, look for similarities. That's what technical analysis is based on. Many, many moons ago, people started realizing there were patterns in the market. And those patterns, when similar bullish and bearish developments and technical patterns developed, something would then follow. And that's what we look at. So I try to expand on that by looking and digging into these tools that we have and kind of coming across in many cases with my own interpretation, not just that of what the textbooks say. So either way, I just want to point that out, that everybody's bullish now, or at least on this indicator. And then I have one more I want to show you, and we'll wrap up here. And this one's a CPCE. That is on stockcharts.com. That's the equity put to call ratio. So it measures the ratio of put buying versus call buying on stocks. So it excludes the indexes. Indexes, kind of that one I had learned over the recent years, is not as accurate. There's so much hedging. Institutions, pension funds, hedge funds, they'll often buy puts on the S&P 500 or calls to hedge their positions. And so this is more of a lot of individual stock traders, what they're doing. And it's, again, what I call my money where your mouth is indicator, because if you buy a put, you are bearish. You're either doing a pure play effective, short on the position, you're betting it's going to go down, or you may own that position, you may be hedging up, but you're also obviously not very comfortable in your long position on Apple or whatever you buy a put on, because it's costing you money. It's going to eat at your returns if the stock continues to go up. So you do that only when you think there's a good chance the stock may drop. And so therefore you just may not want to sell the stock for tax purposes or whatever other reason. So again, it's just shows where the bets are being laid, so to speak, not what somebody's saying they think. All right. And as I've showed you many times in the past, I have a red zone down here. That's where you want to buy. I'm sorry, sell red, obviously sell red. We hit it right here, as I covered. A lot of times you get these clusters of readings in close proximity, and you can get this extreme bullishness. That's what that is. When it drops low, everybody's bullish. They're buying a lot more calls and puts. And then finally, that after that cluster of reading, that last one did the trick. Bear market came right here. You can see we had a drop down to that level, big 21% drop. Back then, didn't happen. Things were a lot different decades ago. But since then, and right here, you can see that drop there. So you can see most of the big corrections in recent years, especially this last one, was dropped there. And again, it's not a timing indicator. Let me say that now, and let me repeat that. It's far from a timing indicator. It just shows where everybody is collectively from a sentiment perspective. And so we can see very bullish. And the other thing I've used many years, I've had this out here, is I put played around with it when I developed it decades ago, 100 period, at least a decade ago, 100 period moving average overlay the CPCE. And you get down to this level, and that also, just like I started out earlier with my low volume indicator on the indexes, it kind of smooths out those spikes. Every now and then you can get just the herd can get really bullish or really bearish, something, missiles flying in the Middle East or something happens, and so you get these spikes. So by putting a moving average, it shows you the trend. And so you get down here and you can see that 100 period moving average was falling down to my red line right before, and it's, again, there's usually a little bit of a lag time, but that marked the end of that great bull market run into the October 2007 highs, followed by the financial crisis. We did not hit that level again to right here. That was followed by a almost 22% drop. We hit it again here. The market went sideways for almost a year and a half with two near 20% drops right there on that drop. We hit it there. There was certainly a little bit of lag time, quite a bit. Not a year, but close to it, maybe 9 months. But then came that bear market or big drop there. And we just hit it, as I identified, I think last week I told you it's the first tag. And now we've actually crossed below there. So you can see that goes down. So that also shows us, again, where collectively the masses are as far as sentiment goes. So while, I hear on TV and the media that too many people are still bearish, that's going to be the fuel for the blow off top because they're going to come back into the market. Well, this is telling me something else. This is telling me they're bullish. And it's also telling me when at the April lows, we got absolutely, and let me repeat, absolutely nowhere near my green zone. This is my buy zone. I've had it here for many years. This is a great time to buy. This is extreme fear. And I'm going to you can see the circles up top. Let me clear it out. Again, this is the last chart, so we're going to wrap up here. This is when you want to buy. These are those circles up top. I'm just coming down below and showing you these were your buying opportunities. Oh, the rest I already had circled. Okay, guys, we got nowhere near there. There hasn't been fear in this market since back here at that correction, to that level. So make of it what you will. But to me, despite what the media is trying to, push out, I see lack of fear in this market, and I see complacency, and so again, anything's possible. A blow off top. The thing about it, they can happen pretty quick in a relative span. It could be for a couple months, or more, 2, 3, 4 months. And then you could still get the big crash. If you get a blow off top, you're just going to see this, say this persistent. You're going to just get what you had here, persistent bullishness that finally manifests into a form of a correction. And if you want to understand why, among other reasons, if everybody's bullish, and again, I'm speaking metaphorically, but if everybody's bullish, he or her has then bought their last share. They've deployed their last dollar and bought their last share of NVIDIA or Apple, and there's no one else left to buy. That's one reason there. There's also other things that come into play with this. So anyway, I'm going to end it there. And again, I just spent 50 minutes telling you what could happen, what might happen, levels. But most importantly you have to have. I can sit here, and I've been doing this for months, and I will continue as long as the charts have the same, technical posture, or it gets even bigger. You have to have that catalyst, and that catalyst is sell signals, breakdowns. When you're in an uptrend, it's like what is that? It's Newton's second law of motion. An object in motion will remain in motion until unless acted upon by an equal but opposite force. And so that's going to need to come in the, you're going to need those sell signals. And then, like I said, that's not the end of the world, but that could be the start of, that 50+% drop. The odds will certainly tick up quite a bit, and then kind of diminish, tick down on the blow off top scenario. If we get there, then we take out the bottom of my T1 zone. That's going to increase the odds even more. And it's all incremental kind of stuff. And so how to trade it is, again, I just spent the whole first part of the video telling you if you're bullish, here's, I think, good support levels that will provide objective long entries where the market's like buyers are likely to step in. But just be flexible, because if they don't step in, and that's the signature of a second leg down, or a more powerful wave in a bear market, when support levels, which I'm using my air quotes now, should, quote unquote, buyers should step in, and they don't, that's pretty damn bearish. So in other words, if we broke down through, let's say we're going to get reactions in here if we get the correction to any of these levels. I guarantee you one or all those levels will have reactions. But if we start going down, let's say you punch right down through the 200s like they're not even there, or you punch through, this level right there like it's not even there. That's the whole get out of Dodge kind of moment. That's very, very bearish. It just shows you there's just no buyers left on the other side, or something else is going on. So again, right now, we're not even close to that kind of dynamic in the market. And I'm going to leave you with this. I've done this long enough that it's almost like a light switch gets flipped. When sentiment changes, it can change on a dime. And all it takes is a couple of bad down days, a couple of big breaks of support, big days down in the market. And when you have that low volume like you have now, and the market kind of petering out here versus these strong advances, it sets the stage technically that you can have a big fat reversal stick, big, something like a big bearish engulfing candle that would then wipe out a lot of traders in one fell swoop, or maybe a week of, you could also look at it on the weekly chart, a week of bearish candles that wipe out a lot of the recent gains. So those are the things I'll be watching for, and I may be watching for those 6 months from now if this market goes up. But I can tell you, if we go up for 6 months, it's going to change the technical posture. We could be looking at something different. So right now, we're not. We're looking at the same thing we were looking at a few months ago, and except with that marginal new and still divergent high, which, like I said, sets the stage for a failed breakout. All right, I will stop it here. This has been Randy Finney with Right Side of the Chart. You have a great day.